Hello, everybody, and welcome to the Speaking of Insurance podcast. My name is Aaron Bollinger.
I'm Brian Bollinger.
Today, we're going to be talking about State Farm insurance. We're going to switch it up a little bit because we've been getting some negative feedback on our recent videos. They're just hating, huh, Brian?
Yeah, who doesn't? I mean, we love insurance apparently too much. So that's the issue here, I think. But nonetheless, we digress. So State Farm, I mean, everybody's probably heard they're going to give back $5 billion in profit. That's a lot of money. If you start reading the fine print, though, if you're in California, I'm thinking it's probably not going to be a lot. And in particular, what it said it was for 40 states, and it's like $100 per car, I think is how they're doing it. Now, this could change. We're just reading headlines and trying to see what's going on. But it sounds like great news. And then when you actually hear about it, what happens in your pocketbook, not exactly the same. So what we're actually seeing in California is rates going up double digit still. And, I don't see that changing. Do you, son?
I don't see the rate increases changing. If anything, it'll be more of a reason for them to bump them up even more. Obviously they are sharing some of their profits that you'd mentioned with their people who give them the money. But it's just a tricky situation because what's going to happen next year? Are they the price is going to go down because they gave back $5 billion? Probably not. That would be kind of counterintuitive for their business model. But obviously they were very profitable and wrote some good business. But I don't know. It's their biggest dividend payout in the company's 103-year history. Is that surprising, Deb?
I think it's really surprising. But what's interesting is, it's a mutual insurance company. So everybody kind of shares in the risk pool. Basically policyholders are owners of the company, which is great. I mean, it can be great if the pricing is within line. But what happens, it gets out of line. And of course, you make different choices. State Farm does have their own manuscript policy forms in a lot of states. We actually with State Farm for a couple of our houses and cars, and they still send out really thin paper, like fold out policies. It's like one of those road maps from the 80s. You know what those are, son, road maps?
Actually, I know what Google Maps is, but I've never seen a road map before. Could you explain what that is?
We used to have these really big things made out of paper. And there actually used to be things called phone books, which again, I'm sorry, or payphones. Okay, but let's not go that far back in time. So with the with the actual map material, that tended to be pretty thick. But that phone book paper, and there's like paper that's like almost like one of those toilet seat covers. It's like that real kind of weird thin stuff. That's what this policy paper is like. And you fold it out and it's got to be like 3 feet by 6 feet or something. It's like a poster. You could put it on your wall and it's got like 2 font. Like you literally don't, if you can read it, it's such small font. It's hard to see.
Well, I guess that's a good thing. I mean, obviously, it must cost a bit to print then, because that type of paper probably might not be easily accessible. But I bet they have some sort of deal figured out with the companies.
Oh, I'm sure that they probably had a deal. They probably had a 100-year supply of that stuff. Is what I'm guessing. So they'll probably be sending those policies out the next 100 years. But we also digress on that part of this. But
did you know that the payments are actually coming out in summer 2026? So for people who want to get that, that summer spray tan on, you're going to be able to hopefully get $100
spray tan. Who doesn't want a spray tan, honestly? But okay, again, probably not something we should talk about.
You look like you've had a spray tan. I look like I need a spray tan. I mean, it's like
you got to get outside. That's the problem. You spend too much time at UCLA right now. That's the issue. Too much studying. But at any rate, we digress yet again. So getting back to this deal with State Farm, I think what we're going to see in the state of California is State Farm is still insuring a lot of people like our houses in Brush and our friends and neighbors in California who have houses in Brush. They've been a pretty good partner. I think the auto side, they've had a long history in commercial auto of being a pretty good provider. We've even had claims, clients of ours and friends of ours, get 7-figure payouts, made on behalf of their personal auto / commercial auto policies with State Farm. So pretty happy with that. I get about the fire claims they had in California, the Palisades and Altoona fire and stuff like that. I think that's still a little bit, I don't know how they're actually doing, because again, we don't really represent those as independent agents. We work with companies that will allow us to work with them. Companies like State Farm currently are not letting us do that. They have captive agents. So if you have a State Farm agent and you have a State Farm problem, you need to go to your State Farm agent to really, be able to get them to fight for you. There's good and bad agents, independent agents, good and bad State Farm agents, I'm sure. But again, if you find a good State Farm agent, you like the policy, it can be really good. We've had family members with them for decades. However, after 2 or 3 claims, like with every other insurance company, they tend to be a little less excited about keeping you. So do keep in mind that if you get a small claim, we still don't recommend filing it. Even if it's justifiable, you might end up paying more for the insurance than it's actually worth in terms of getting that, a couple bucks back from the insurance claim.
Yeah, obviously. I mean, this goes into the other podcast topics we've been talking about. If you haven't watched those, go back, watch those. We talked about insurance premiums basically and how it might not be worth it to file a claim that, it's just double your insurance premium. Because over time, obviously, that probably is going to leave you a net negative. But I just had a question for you. Guess how much profit they had reported in 2025? So net income.
I'm thinking 8.6 billion, but that might be my bad number in my brain.
I don't know where you read that. It's $4 billion off, which is a pretty penny. It is actually 12.9 billion in net income in 2025. So this leads to the question: is this just a PR move, Brian? Is what's State Farm doing here? Are they just trying to? I mean, they're posting it everywhere. It's like they're singing it from the rooftops. They're all the State Farm agents are probably sending out the mailers. Did you get your $20 to $100?
$100 a car issue, but only in 40 states. So here's the thing, California has been one of the larger states, I think, for most insurance companies for the last 50 years, right? I mean, since the 1960s, the population of California has exploded. It's kind of pulled back a bit since then. But nonetheless, we're still the Golden State. And it does feel like a lot of people make good money here. The downside is, with Prop 13 and all the other Prop 12, I forget the number now. There's so many props we have in California. 13 was property tax. There was, I think, 12 that limited the rates. At any rate, the bottom line is there's another one thing, 201, but it doesn't matter the numbers. Point being that there's regulations. Every state in the union has their own Department of Insurance. And that Department of Insurance works with the insurance companies in that state to help set rates. And, even things like these return of premiums are going to be coordinated with 40 different departments of insurance. So again, it sounds like they've already kind of made their mind up. I'm pretty sure it's pretty hard for a Department of Insurance, person at the state level to say, no, we don't want our people in our state, our policyholders with your company to get even $100 back. That wouldn't be good PR for those elected officials. So I'm pretty confident that, those checks are going to go out. They did really make money. The interesting thing about insurance companies too, that this gets nerdy again, sorry, but they have different companies inside of them. So they'll have like a parent company, that might be one of the companies. But a lot of times each state or each collective area of states have kind of like their own little pool of insurance resources for that region. So you think about it, like an area like Florida in the South, especially on the Gulf Coast, they have issues like hurricanes that come through so often. So they're more likely to have, hurricane related losses. Obviously, risks in the West, California, even all the way out to Colorado, we're more likely to have maybe wildfire exposures. So, but California being such a big state probably has its own insurance company. And that company for a while now has been claiming that they're not getting enough rate, especially on the personal side, homeowner side. They're claiming they haven't been collecting enough. And so you do see issues like even in the news recently where they're saying emergency rate increase 20%, 17%, 25%, which means that it's going to go up. That's the base rate filing. That's what the whole tide is lifting up that 17%. That's not $100 back. I think for most people, that's hundreds of dollars additional premium, number one. Number two, we're also seeing it, happen that maybe the valuation of your home, because the inflation's happening and it's costing more to replace the stuff in your home. The 2x4s cost more, the plywood costs more, the labor costs more to rebuild your home. So you're seeing replacement costs go up, say double digits or low to mid single digits. And so you had 17% of, say, pure rate, and then you add about another 8% even for inflation on the cost of your rebuilding of your house. That's a 25% rate increase. I mean, there's a lot of people in California that are struggling right now to justify paying for their homeowners insurance. And on top of that, there's been specialty companies, I'm thinking like, I don't want to use too many names, American Modern, some other companies that specialized in writing homeowners policies. And a lot of those places, like in the fires in LA, they had some pretty big losses. And so, we're seeing it kind of become more difficult for some pockets of properties like mobile homes or manufactured homes in certain zip codes to get reasonable coverage. And so, people still are getting pushed into the FAIR plan. The CADOI, really, Department of Insurance, is trying to pull people out of that collective risk pool and get these preferred companies like State Farm, Farmers, Allstate. Of course, we have all of our, Travelers, Hartford, Liberty Mutual, all the other companies you heard of too, not just the ones that are captive, but the ones that do write through independent agents, trying to get them to write more business and to be able to price it accordingly so that they don't lose money on it, but more importantly, that they don't gouge the consumer. And I think that's the biggest concern here is if you see insurance companies consistently have $12 million, underwriting profits year over year, that does question, you do begin to question, what are those rates? How are they making so much darn money? I do think, honestly, son, this is probably an anomaly. I think that the last few years since COVID, there were, obviously in COVID, they paid out a couple $100 everybody too. And then what happened was we all started driving again. People started speeding, all that kind of stuff. Claims cost went up. I still blame those darn billboards for attorneys everywhere on the freeway as, inflating that claims cost and pushing overall auto rates, commercial and personal, up double digits. And even if they do come down 5 or 10%, you think about it this way, that's where they were 6 months, a year ago, right? It's not like it's going to go back to where it was 6 or 8 years ago in terms of the rates and pricing. It's only gone one way, and that's up.
Sorry, 1 second. So I just wanted to add that in. Sorry, my wife is calling me.
Right.
She's at her eyebrow thing.
More importantly.
So I just wanted to give you a round of applause there. That was officially the longest single person talking clip in Bollinsure podcast, speaking of insurance podcast history. So
I can do more. I can do long-winded.
You touched on all of homeowners insurance. You touched on all of State Farm insurance. She couldn't find parking. Anyways, like you say, 12 to 13 billion dollars in profit is obscene for an insurance company. Right?
Again, if they're doing $1 trillion, maybe it's justified. But if it's, they're doing
but
whatever they're
still,
doing.
I mean, geez, like you're talking about billions of dollars that's coming out of people's pockets, like pretty much. I mean, that's not being paid in claims. Talk about their claims department. I personally haven't worked with State Farm. I mean, you're currently insured by State Farm. Do you know how their claims handling is?
I'm personally agnostic. I don't say good or bad things about claims departments with State Farm. So far, what I've been is lucky, knock on wood, haven't had to file a claim. So, it's easy not to engage with them and to not have experience with them. But I have had clients, like I said, that have had, pretty big claims paid out, and they seem to be, in line with everybody else. One other headline in the news right now, too, I don't know if you saw this one, the Insurance Journal reported recently, actually today, that they're saying that rates are coming down for insurance, for commercial, I believe mainly, but it's coming down for everything but workers' comp and general liability. So you think about that. I mean, if you're a business, unless you're property heavy, which means you're a landlord, probably not in California or Florida or any place like Texas where the wind and the hurricanes or wildfires are problems. Maybe if you're in the Midwest or upper U.S., maybe you're seeing some savings on the property side. In California, we're getting hammered on the property side. Like I said, inflation and rates are both still going up. And then the second part of it, workers' comp rates have stabilized and are starting to go up in California. We're starting to see an increase in claims and severity and even frequency a little bit in terms of what's happening. So that's putting pressure on those things to go up, which again, if you're a business, especially a contractor or, labor heavy manufacturer, the property savings, if there is any, is not going to save your bacon. You're going to be really paying a lot for liability insurance. And those rates have been very steady, if not a little on the uptrend. They're also reporting that the umbrella policies have been coming down in terms of price. The excess liability policies at the Insurance Journal, they were actually claiming that they are down. What they say? They said they were down 8.84%. I can tell you that in California, we're seeing companies like Liberty Mutual, essentially decide not to renew, $5 and $10 million excess liability policies or commercial business umbrella policies. They're deciding to limit their exposure. And this is the reason why in California especially, but also other litigious states, we're seeing an increase in these large jury settlements. So claims that used to be 500,000 or $1 million, we're now seeing them hit that $5 to $10 million mark. And it used to be also that first $5 million layer of coverage would be, expensive, mind you, but then the second $5 million layer would be a decent amount less costly. That doesn't seem to be the case as much anymore in California. So maybe they're talking about these extra layers of excess liability or umbrella policies coming down in price a little bit. And that might be. that does fluctuate from carrier to carrier and time to time. And if these insurance companies continue to make significant profits like this, where we will probably see more capital, more risk enter into the industry, some newer players, broadening their appetite and placing bigger bets on insurance. Remember, insurance is essentially legalized gambling for the insurance companies. They are literally the house at the roulette wheel, and you're just putting your chip on the table saying, gosh, if my house burns down, if somebody sues me for everything I have, I want to be covered. Now, you don't get to see whether or not really that your number lands or not, unless you're the one self-insuring yourself. And there are people now that are doing that on the property side, like we just talked about. And, I can see where that'd be scary.
Going back to State Farm a little bit here, obviously they are a mutual insurance company, which is what we talked about. So basically, the policyholders own the company, right? And so, how often are there any other types of, obviously, I mean, there might be a few insurance companies, but any other types of companies in general that give their excess profits back to customers? Like, do you have like a couple of examples?
AAA routinely does it. Their auto rates might be a little higher than some other options, and they try to give it back if it's a good profitable year for them. I don't know that they ever give it back on the property side. Again, I think they got hit pretty good here in California. One of the things about those big wildfires though in California, that was pretty much the worst that happened last year in 2025. The insurance companies actually did all right, and the reinsurance companies did all right. Obviously, State Farm did just fine, outside of California. And so, you read those kind of headlines and you think, these companies make a ton of money. The flip side is if a hurricane hits one of our big cities, if some other big wildfires go through and, harm, some other state besides California, which I know Colorado's had some challenges in the past too. Arizona's been struggling sometimes. Mostly those are in the peripheral of very large cities, not really taking out major towns, thank God. Obviously, certain states are a little more proactive with forest management, which helps reduce some of that wildfire risk. But nonetheless, it is always present.
Wildfires. All right. Okay. This is going to be the most dense description of a podcast in speaking of insurance podcast history, as we have transitioned from State Farm insurance to AAA insurance to fires and stuff.
Well, we might as well talk farmers then too. I mean, we talked about every insurance.
We can talk about farmers in another one, but do you know the origin story of State Farm, Dad?
I have a feeling you're going to tell me. I bet it's something with farms, though, because there's a word farm in there. So I'm going to put money on farms.
Ding, 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 ding. So in the 1920s, farmers are being overcharged for auto insurance because insurers were pricing everyone the exact same. So it didn't matter how much you were making. They were just basically just charging everybody the exact same. And so there was a guy named George McCarley, and he thought, farmers drive less and have fewer accidents. And so this is for the auto insurance side. So he created an insurance company specifically just for rural drivers, right? So not just exclusively farmers, just rural drivers. And this was where he would offer them lower rates because he was able to make more money on them since they had less driving exposure. And so this is obviously an earlier example of what we call in the insurance industry risk segmentation. And so obviously this is now a modern thing in insurance pricing where if you have a profession, some people classify you off your profession. We know that Mercury Insurance Group in California, they got to ask for, what type of job you have, right? I mean, if you're driving a business vehicle all the time, that's probably not going to be the highest, risk for them. But then again, it might be more risk, right, Brian? Because that's very nuanced, right?
Well, we have clients that drive Lamborghinis and clients that drive old pickup trucks, right? Everything in between. So we're pretty agnostic on that. But we do know that the more expensive car you have, the bigger target you are, the name of your company on the side of your truck or car, you're going to pay more for insurance. We know those things, right? Because you're more likely to have unfortunately, an attorney, get involved in the claim. So, keep in mind that some of these things, it's not just how many miles you drive, and also commercial insurance, right? Remember, it's also based on radius of operation. Some companies don't look at how many miles you drive. They go, if you're within 50 miles, we'll give you better rates. If you're going to drive nationwide like a crossroad trucker, we're going to have to charge you a lot more because you're further from home. And there's some data that suggests the further you are from home, the more likely you are to have a bigger issue. And, but then we also hear it's, when you come back from vacation, it's that last mile or two where most accidents happen. I don't know if that's true or not, but anecdotally, that's what people say.
Well, no, I've actually got a theory on the reason why State Farm Insurance is making so much money. And it comes from this statistic here. The average auto rate cuts of they're announcing that they're cutting auto rates on average by 10%. And then the key part of this for me is in 40 states. And so you see
Yeah.
that and you're like, oh my goodness, my rate's going to go down 10%. And it's like, no, dude, you live in California. That's going up. I'm
Don't
sorry.
don't
You're
don't
the
joke
one.
about California. We're not here to bash California. That's where we
Well,
live.
but
Yeah.
that's how it is. I mean, it's literally how it is. We're the ones that are excluded from these, the getting back the money and whatnot, and you're also going to be the ones that are going to be excluded from the rate decreases. It's
But it's great
literally
marketing and PR out here. I must admit that State Farm is really, I think setting the expectation that rates are stabilizing or going down. But again, we just got some renewals from them and it's up double digits. I mean, it's the same problem we have with, it's hard to talk to clients every year and say, hey, your insurance has gone up. I mean, we have had some luck with workers' comp, right? Bringing people's prices down this year. Some issues, come up with liability. It's a little harder to do much just because the prices there are kind of pretty stable. But we did move somebody from, one company, excess liability umbrella policy to another because the company wouldn't give us the limits that was needed. So there are opportunities, little pockets of opportunity, I would call it. But it's not as robust and easy to do as it used to be, trying to keep those prices stable. Workers' comp, again, that's an area that we're starting to see it tick up, especially in California. It is crazy to me though, son. We do know a lot of companies thinking about leaving California or moving to California. It's important to understand what the insurance costs are for your business in different locales. One of our clients has a secondary operation in like Nevada and Arizona, and those rates are substantially lower for workers' comp than in California. We've talked about it on past podcasts, so we're not going to, beat that horse, so to speak, but we just want to kind of mention that every market is local, every property is unique. And, it's important that you understand, what you have and what companies like to insure your particular situation.
I want to go back to State Farm and their profit sharing. So obviously they had reported $12.9 billion in basically net income from, making money on things that either they didn't have to pay out. I mean, lower repair costs, you name it. And of that money, they had given out like $5 billion on average, right? So that's about $7 billion that they're going to be keeping in the pocket a little bit, and saving it for a rainy day type thing. With that announcement of the decreased rates in 40 states by 10%, that actually means that in total, premiums are going to be going down by 4.6 billion in terms of premium savings for people across those 40 states. So if you factor that in, that's $5 billion less than the amount that they get to keep in their pocket now, which, I mean, between the $5 billion in profit sharing and the $13 million, that was $8 billion, right? It's a lot of money, obviously. But then you take away that $5 billion from those rate decreases, and that's $3 billion. You'd think that that's a big margin. Oh my gosh, they're pretty much just going to be making billions and billions of dollars over time. But if there's a year where some of the liability exposures in some other states start to go up, and those rates that they had decreased for that year should have actually increased or not decreased by 10%, maybe 5%, the second that those small percentages change, they start losing money. And when they start losing money, things go south. It's good that they made money this year because they do have that money in their pocket to pay out some excess claims, and obviously they're investing the money that they get right now from premium. But I mean, do you ever think that solvency is going to be an issue for some of these companies that, do a bunch of profit sharing and, announce rate decreases and, yell it from the rooftops like they're saviors?
Well, that's a lot of speculation there, so we don't do that. But one thing I have seen historically is if the rates get too low, the insurance company does eventually lose money. And as soon as they start to lose money, solvency is the wording that they use. Now, one thing to keep in mind is every insurance company is supposed to reserve any potential claim for enough money to settle it in the future. So there are accounting games that some companies have done in the past, or they're not reserving claims large enough. And then it comes back to, hit them in the face, so to speak, when that tail risk comes back on them. The second part of it might be something to think about is just because the rates came down, that's great. What that also does for them is it might allow them to insure more people in that state, right? They might win more business, and that might actually help improve their profitability in certain locales. So they might like double down on a certain zip code or for a certain type of, person or business. And when they do that, they kind of focus in on a certain risk parameter that they're like the best at, the cheapest at, they seem to really want. And what can happen with that is they place the bigger bet on that one particular type of person. Let's say it's 16-year-old drivers, right? There are companies out there that want youthful drivers. There's companies out there that want, what's that?
High risk companies, and
There are high risk
I think
companies.
it's the State Farm Insurance. They are the specialist in auto insurance. They're the largest auto insurer in all of the United States of America.
Yeah, and again, but they're kind of a generalist. I think. I don't think that they're the high risk people.
They don't have as
What
much
but
percent.
one of the things that'll happen is they'll somehow in their underwriting models and they're putting these 10% discounts in or however they end up doing it. It probably won't be just 10% for everybody. It'll be like more in certain zip codes where maybe they had less claims and that'll allow them to maybe write more business in those zip codes than other zip codes. It's just so hard to know how that'll actually play out.
Well, sure. I was just giving the numbers. I mean, $3 billion sounds like a lot of money, but when they did, like you say, $13 billion last year, pocketed 8 billion. I mean, you start pocketing 3 billion, that number keeps going down. If the claims start going up, then that's a big issue. And obviously, the irony to this is that car insurance costs have nearly doubled since 2016. And so, obviously, with the claims and the settlements that you talked about, the attorneys and things like that we can, scream and yell at and get all angry at. The truth is that these claims are treated way more seriously now, right? I mean, people who do get injuries, they get a big, pretty paycheck. Hopefully, some of the time if you're properly represented. I don't know about Sweet James or those other people that no free promo, right?
Well, I do know that the attorneys do a lot of advertising, and I'm assuming that they're making enough money to pay for that advertising. So, with that said, we all pay for that in higher rates, and the fact that rates have gone up,
Yeah,
some states more than double, I'd say, since 2016. Even if they go down 10%, right? That's nowhere near. They'd have to go down 50% to get back
yeah.
to where they were, just a decade ago. And, nothing else has really gone down in price. I mean, milk hasn't, gas hasn't. I mean, maybe it fluctuates, but you know what I mean. And,
Sure.
cars are expensive. Everything's more expensive.
Yeah, everything is more expensive, right? I mean, and you touched on it perfectly. Is $100 really that meaningful if your insurance rates have doubled over the last, 9 to 10 years? I mean, if you're paying an extra, $900 a year, does $100 1 year? I mean, it might, thread the needle for some people, might help some people make ends meet, obviously, but and it might, be a nice little pretty check for some other people, but again, not to us poor folk in California, not poor by wealth, just by we're the unlucky ones in terms of we're the hot spot for the litigation costs, right, Brian?
Yeah, I think Southern California is worse, I hear, than Northern California and Central California. But again, at the end of the day, I think we all get lumped in together, and we all pay a lot. I do think it's important from time to time, look at your coverages, look at what you have. Again, at the end of the day, you're trying to make money, you're trying to save money, you're trying to feed your family. Insurance is just one of those expenses. It's really frustrating. And when you feel like you have no control over that spiraling increase in cost, that doubling in the last decade, it's a problem. And it's hard for us in the insurance industry to say, hey, we've got a magic wand we can wave to lower that cost. The only way we can try to do is try to find a carrier that likes you and your family or you and your business and try to get you a fair deal.
Fair deals hard to come by. I mean, in terms of relativity to like we talked about 9, 10 years ago. Fair deals now are completely different, completely changed. A good deal for some milk nowadays, it could, just unreasonable. It's unreasonable, right? Even the insurance deals that we can offer, it's still hard, and it's a hard market. Obviously, we do our best, and it's good to have access to a bunch of different companies. But if you do, like State Farm, have pretty much a monopoly over the ability to write a lot of different types of auto insurance, and that's a good thing as well. But it's good to get a bunch of different opinions, and hopefully you're here keeping an open mind if you're still here. But did you know? Guess how many physical agents they have, Brian?
In nationwide or California?
Nationwide.
I have no idea.
Number
3,000.
19,000. And so
I'm
that's
way
where
off on
the
that.
term, like a good neighbor, State Farm is there, right? They have a bunch of physical agents. Even in the digital era, they have, I think it's around 19,000 employees total. 3,000 of them are physical agents, which is crazy. And so those aren't just people that are in the United States, those 19,000, but they actually have, 19,000 physical agents. Sorry, I just mixed up our numbers. It's 19,000 physical agents and 65,000 total people who they have employed, which is very impressive numbers for physical people in California riding through State Farm. Do you think that they're a good neighbor to?
For us, they've been a reasonably good partner. Now, this is the thing with insurance companies. They run hot and cold. Sometimes they're great, some certain companies, and then, a couple years down the road, they're not good anymore. I think State Farm's been pretty fair to us. It is getting close, I think, because the auto costs might be a little higher, where there might be another option for us that would be better on the auto side of things. But again, changing one to save $100, is that really, what we want to do with our time? How do you maximize that long-term relationship and value? I do think, as we've talked about before, son, is that these insurance companies, if you've been with them for a few years, they've made some money on you. If you do have one off claim, they're more likely to stand by you. You start switching companies every year and you have a claim or two, super likely that company's either going to really surcharge you or not want to insure you.
Yeah, well, that's the game with every single insurance company. Obviously, it's not just exclusively State Farm. One thing that I do want to talk about is the controversy around State Farm. Do you know that they have actually recently had a no, $250 million settlement tied to legal controversies in Illinois court in regards to claims handling, discriminatory lawsuits, and underpaying of claims? Are you surprised? Me, I'm not surprised at all. I think that lawsuits are a natural thing that does happen in terms of insurance, and obviously it's a little bit scary though. And it sounds bad, right?
Honestly, we talked about this in a prior podcast, and I don't want to beat that horse either. But I don't like beating horses. I don't have any horses right now. So anyway,
Don't
I
don't
digress.
beat a horse.
Don't beat dogs, horses, anything. No, no, no beating. Sorry, bad words. My point being that we
You're
need to think
fired.
about it as they've got a duty to their shareholders, which in this case are policyholders, and to make sure they don't overpay out on claims, but they also shouldn't underpay out on claims. And so, yeah, honestly, that's the hardest job in the industry right now is the claims adjusting, and a lot of it now is being automated. I think there's a lot of tools now with AI and things like that. They're trying to really, contain it. Again, when I hear a state like Illinois or California, New York or New Jersey, certain states, and I hear class action lawsuits or things going on, wouldn't say it's a surprise to me, but it's also not something that I'm like, okay, this could be huge everywhere. I don't know how to really feel about that. And if you look at any insurance company, I mean, there's a company that wasn't State Farm. I don't use the name of them, but we had a neighbor. You might remember this guy. And Bob had a house, and he had not hurricane. He had a tornado hit his house, and messed up his barn. Rest up a fence. Took his barbecue and threw it. I don't know, a quarter mile away, kind of thing. Like it was just nothing. Well, it ended up shifting the house about a quarter of an inch, 3/4 of an inch, but it was like pulling away the walls and did some really kind of weird structural damage to his house. All he knew is that his window blew out. And so he was trying to get the window replaced and do some, basic stuff with his insurance company. And the insurance company claims adjuster was outsourced. Because here's the thing, most insurance companies don't have their own claim handling teams. They outsource it to somebody else to come over, and that person comes in as a claims adjuster and starts to work for the insurance company. And they want to try to, get more business with that insurance company. So all of a sudden, they kind of have this financial interest to minimize what they pay you, hypothetically, but that's just my personal experience. And so we tend to see those kind of situations happen. And then we try to help people, navigate that. We didn't insure this person, so there's only so much I could do. But I did, put some pressure on where I could. And, they agreed to relook at it. Well, they ended up calling out engineers and specialists and stuff like that. And they actually measured that house. And that's when they found out that it actually moved. And it was, I think in certain places, it was just like an eighth of an inch separation on the wall. But like when you have a 2x6 wall, you got your stud, then you have the plywood nailed to the outside, that makes that whole thing really stiff. You start having spaces and gaps and that thing start moving around more. That means it's not the same house as it was before that big wind event, which makes sense. But this was like latent stuff. These were defects and damage that the naked eye couldn't see. You'd see, 5 shingles blown off in a window, and you think, oh, that's nothing. That's 5 shingles in a window. That should be, $1,000 and go away. Well, it actually turns out this house had a lot of damage. I mean, even the fireplace was pulled away from the wall just because of the way that momentum, when that big gust hit it and kind of pushed the house a certain way, the fireplace kind of stood there and it just kind of changed everything inside that house. I mean, so this guy, I think, ended up getting a lot more for insurance claim handling.
How do you obviously like? I mean, it seems like you just mentioned it. You can't see that to the naked eye. How can you actually determine that there was damage there? I mean, obviously you can get those engineers out there, but I mean, you don't think you need any engineers if a small thing hits and you just notice a little problem with your window, right? I mean, you're not a expert, you're not a mechanical engineer, whatever, the structural engineer. So how do you know? I mean, you just gotta live with it.
Yeah, I
Yeah.
think it's back to like not sweating the small stuff at a high level. Like there's a book written about that. I don't know who the author was, but that's their line, not mine. So my point here is, you know, like when you have a house, we used to have fireplaces in houses and people would have smoke come in their house and it was kind of no big deal. Now people have, HEPA filters in their house, especially after COVID, super clean, right? HEPA vacuums, like we're trying to keep it low dust, low pollution in our homes, really trying to keep things clean, eat clean, live clean, all that kind of breathe clean. And so when a wildfire goes through your area, right, and you get a lot of soot and smoke inside your house, right, there were a lot of companies that were going in and measuring, how much soot is inside of your house and getting you to either get it professionally cleaned, in some cases ripping out ductwork and going down and, repainting walls or ripping out floors and carpets and things like that because of the amount of pollution. And the other that's kind of changed in these fires in LA, I would say from my perspective is you should look at soot and smoke as just being soot and smoke. And, when we saw the images of the horrible fires go through, California, we saw a lot of EV vehicles, a lot of lithium batteries, a lot of, cars and automobiles and stuff get just essentially melted to the ground. And when that happens, the toxic, chemicals and heavy metals in those cars actually gets released into the air. And one of our clients actually had their floor tested in their house and they found really high levels of cadmium and lead. And I don't know what they're doing now to do that. That's a claim, I think, with AAA. At any rate, they're having to figure that out. How do you reseal it? Can you scrub it off? What do you do?
Sounds like a good podcast or a good separate video. State Farm Insurance,
Yep.
the biggest auto insurance insurer in the United States of America, has just announced that they are going to be offering some people exclusively in 40 states 10% rate decreases as well as $100 back in your pocket for every car, pretty much. So people who own a bunch of cars, rich get richer. People who don't own any cars, poor get poor. Same sort of dynamic, I guess, between insurance companies and the real world. Huh, Brian? Or is that very polarizing?
Yeah. Also, I'd say it's compared to what, right? What are the other insurance companies charging, right? Are you overpaying by 10 to 30% and they're just giving you part of that overpayment back? Or are they super competitive in your state? And is that going to represent a tremendous value and more people should be insured with State Farm? I don't know the answer to that question, but it'll be interesting to see what happens.
I think I know the answer to that question. I think if you get a bunch of people to work on it, if you get like an independent insurance broker to gauge the rates in your area, and they've got access to some good companies, and you've got State Farm working on it. I'm not saying you want it to be a competition every year for your business because it's important to have a relationship. But if you're wondering, hey, is there a better deal out there? I mean, I've been paying $3,000 in I don't know, Texas for this car that I've got with State Farm. Heard they were the best. How do I know if they're the best? Go to somebody who is admitted there, see if you can get another quote, see if you can get another indication, and see what ideas you can compile together. And obviously, if you got a great relationship with State Farm, have a bunch of claims, and they're charging $3,000, then definitely worth staying there. But gauging the market is an important thing if you want to see if there is any other options out there for you, your family, and potentially your pocket. By pocket, I mean wallet. All right. Okay. So I just want to say thank you for your time, Brian.
Thank you for your time. Hope you're doing well, and we'll talk more later.